When markets get noisy, interest rates swing, and risk assets feel uncertain, investors often look for one thing: stability. Today, we're taking a deeper look at the Schwab Short-Term U.S. Treasury ETF, ticker SCHO, and why it's become a core tool for both retail and institutional investors. This is the ETF Investor. Let's break it down. SCHO is a passively managed ETF designed to track a market value-weighted index of U.S. Treasury debt with remaining maturities between 1 and 3 years. The focus here is very intentional. By targeting the short end of the Treasury yield curve, SCHO aims to minimize interest rate risk while maintaining high liquidity and credit quality. The securities included in the index must meet several criteria. They must be U.S. dollar denominated, fixed rate, and non-convertible. The fund excludes strips, which are coupon and principal components separated from Treasury bonds, and it also excludes state and local government bonds. This keeps the portfolio clean and purely focused on traditional Treasury notes. One important detail that sets SCHO apart is its benchmark alignment. The ETF's underlying index and its benchmark are actually identical. That means tracking error is extremely low, and investors can expect the fund to behave almost exactly like the short-term Treasury market itself. For conservative investors, that level of predictability matters. The portfolio is market value weighted, so larger Treasury issues naturally carry more weight. The index is updated monthly, allowing the fund to stay aligned with current issuance and maturity profiles. Schwab also uses a straightforward replication approach, which helps maintain liquidity and transparency. Now let's talk about how SCHO behaves in real portfolios. Because the bonds mature within 1 to 3 years, SCHO has low duration, which translates to lower sensitivity to interest rate changes. When rates rise, longer duration bonds tend to fall sharply. SCHO, by contrast, typically experiences much smaller price declines and benefits sooner from reinvesting at higher yields. This makes SCHO a popular choice for capital preservation, cash management, and defensive positioning. Many investors use it as a cash alternative, especially when money market yields are attractive, but they want daily liquidity through an ETF structure. SCHO is also widely used by institutional investors and traders. Its liquidity, yes, tight bid-ask spreads, and deep Treasury market exposure make it suitable for short-term positioning, collateral management, or parking capital during volatile periods. That said, SCHO does have limitations. It is not designed to generate high income, and it does not provide meaningful protection against long-term inflation. If inflation runs hot for extended periods, short-term treasuries can lag real purchasing power. This is the trade-off for stability. Another consideration is opportunity cost. In strong equity bull markets, funds like SCHO will underperform risk assets. That's expected. This ETF isn't about maximizing returns. It's about controlling risk and preserving flexibility. So who is SCHO best for? First, conservative investors who value stability and predictability. Second, investors nearing or in retirement who want low volatility fixed income exposure. Third, active investors who want a liquid, low-risk place to hold capital while waiting for opportunities elsewhere. The bottom line is simple. SCHO does exactly what it promises. It provides clean, efficient exposure to short-term U.S. Treasuries with minimal complexity, minimal volatility, and high liquidity. It's not flashy, but in portfolio construction, boring can be very powerful. If this breakdown was helpful, subscribe to the ETF Investor and let me know in the comments how you use short-term Treasury ETFs in your strategy.